2023 was the worst median performance of the average stock relative to the S&P 500 since the dot-com bubble. What noticeably happened following this underperformance during the dot-com bubble was 5 years of outperformance with your average stock. So let me put this into a little bit of context. In 2023, we had impressive S&P 500 NASDAQ returns because of Apple being 10%, 11% of the NASDAQ, Microsoft being about 10% of the NASDAQ. You get the idea. Those stocks did well. The rest of the names, well, did not, or not nearly to the same extent of your indexes. But what theoretically could happen next is the next couple of years, you could see the average stock, I would argue small and mid-cap stocks, way outperform the index. So this is a video that could make you a lot of money. We're going to dive into what's going on in our markets. Today is the official start of the Santa Claus rally. What is the historical return of the Santa Claus rally? How much cash is currently on the sidelines that could come back into stocks? And believe it or not, 65% of large cap fund managers are underperforming the S&P 500. This is building into a narrative that is unshakable, something you need to know that will help you make more money. Let's go ahead and get started. Today is the official start of the Santa Claus rally, which in theory is from December 25th through the first 2 days of the new year. A couple different reasons for this. If you're unfamiliar of what the Santa Claus rally is or want a refresher, the key takeaways from Investopedia state the Santa Claus rally is the tendency for the stock market to increase during the Christmas season. Theories for the rally include increased holiday shopping, seasonal spirit, and institutional investors settling their books before going on vacation. Like many market anomalies, the Santa Claus rally may be random with no future guarantees. About 80% of the time, the S&P 500 rallies by about 1.4% within this 7-day period or so, 10-day period or so. It's a very aggressive rally. From 2002, every year you've seen a positive return in the S&P 500 during the Santa Claus rally, besides 08, besides 2012, and besides 2018. Even more recently, in 2019, you were green. In 2020, you were green. In 2021, you were really green, up about 5.5%. And even in 2022, you were up about 1% during this Santa Claus rally period. So if this happens again, it will be the 5th year in a row with a positive return for the Santa Claus rally. So that looks pretty good. 80% of the time you're green. I would argue we're probably going to be green this time around based on statistical probabilities. But 2024 is where things get truly exciting. Forget the Santa Claus rally. We could be looking at 50+% returns for small and mid-cap stocks, aka the ETF that tracks small and mid-cap stocks. IWM, by some analyst projections, could rally 50%. And that is according to Tom Lee. Tom Lee says you really want to be in small and mid-cap stocks, not as much so in the broader indexes or mega cap tech. According to Tom Lee and FundStrat, 65% of large cap fund managers are trailing the S&P 500 returns, but only 47% of small cap funds are underperforming small and mid-cap stocks. This is mainly because if you are a small cap fund that is only allocated to small caps, a lot of small caps did very well. Fubo did well. SoFi did well. Palantir did well. The list goes on and on. The index itself, not so much. The Russell is still down about 17% from all-time highs. But compared to the S&P 500, where a lot of stocks really did not do anything close to some small caps, it was really all concentrated this year in the top 7 to 10 different stocks, the largest 7 to 10 different stocks on the S&P and the NASDAQ. Now the transition is likely here. In 2024, you could see trillions of dollars come back into our markets. Just the money in money market funds alone is $6.2 trillion. The total market cap of small caps is about $2.3 trillion. So just a fraction of this money coming back into markets, well, is going to give you quite an impressive gain next year. And like I said, when you have a period of time where the average stock way underperforms the S&P, well, the last time this happened to this degree was the dot-com bubble, and the next 5 years in a row, stocks, the average stock, did very well. And it looks like small and mid-cap stocks are really getting to the point of a much larger breakout from here. The number one question is, do we head into a recession or do we not? If we do see a recession, we're gonna have big problems on our hands and stocks are going to do very poorly. But according to the S&P 500, about 10% is left to the upside before you start to really max out valuations. And even on a long-term trend dating back to the dot-com bubble, you would be connecting 3 peaks in a row. This is also roughly in line with what Fundstrat's top analyst Tom Lee expects the S&P 500 to do, around 10% by the end of 2024, and he does expect a pullback at some point in the first half of 2024. But Fundstrat's Tom Lee, remember, the only analyst to get the 2023 outperformance correct. Everyone was forecasting these recessions and stocks hitting new lows. Tom Lee was correct, predicting the S&P 500 would hit 4,750 by the end of the year. Tom Lee suggests every single month in 2024, small cap stocks could be positive, just a continuous rally as money comes back into our markets. But again, there are some signs that maybe a recession is brewing. I would take the contrary argument and say maybe we're already in a recession, or at least have been in a recession for a long time. I mean, look at the price of gas. In my home state of Michigan, it was $5 at one point. I just got gas at $2.77. That helps me, that helps the next guy. That can lead to spending elsewhere. You can make the argument, if the Fed cuts rates 6 or 7 times in 2024, that's going to allow people to get a mortgage at an affordable rate, to be able to afford to buy the average house in the US. What does that mean? People can sell their home they have a lot of equity in, potentially spend that money elsewhere in the economy, buy a new car, buy Joe Schmo products, right? That can also spur the economy. I just went to Walmart because I do all my Christmas shopping the day before Christmas. You know how, guys typically are. And there was a lot of deals out there. I was honestly shocked at prices on some things being so low. But this is what Walmart CEO said. He said to expect deflation coming over the next coming months, really throughout all of 2024. How can this not help boost the consumer? As rates fall, it should be a better economy, at least in theory. So your number one danger for 2024 is a recession. If we avoid a recession, we should be in a pretty good place for especially small and mid-cap stocks. After all, when you look at this chart, ever since the Great Depression in the 1930s, recessions have become shorter and less common. As Puru Saxena points out on X, the S&P's 500 performance after the initial rate cut during recessions. Out of the last 7 of 8 recessions, the bulk of XPX losses occurred after the initial rate cut. The only time the S&P 500 bottomed with initial rate cuts was in the 80s when its P ratio was 7 and you avoided a recession. So ultimately, whether we go higher or lower in 2024, it comes down to whether or not we avoid a recession. Greg IP, he's the chief economics commentator for the Wall Street Journal. He says, has a recession been avoided? Probably, but not guaranteed. There are still lags. After subtracting healthcare and government, employment growth is pretty weak. But as financial conditions loosen, whatever your recession probabilities were, you have to lower them. You also have the University of Michigan Consumer Sentiment Index that has now been below 75 for 29 consecutive months, surpassing 08 to 010 as the longest period of extreme negative sentiment on record. This means one of two things. Either we're heading into a hard landing, a very deep recession, or maybe we're, as a contrarian indicator, so bearish right now, things get better from here. And if you are bearish on 2024, remember this: you are betting on a 4-year bear market or fourth bear market happening in a 6-year time period. The last time this happened in S&P 500 history was never. But the main reason for the recent Fed pivot is probably the contraction year over year in GDI. Since 1950, this contraction has only occurred either just before or during a recession. There has been no false signals ever since 1950. And take a look at this red line over here. You have now went slightly negative. That's probably why the Fed has drastically changed their tone recently. That and the fact that inflation is actually under 2% if you're looking at 3-month and 6-month annualized figures. Grandma got run over by a reindeer. Also, the yield curve inversion is one of the biggest on records, and this has almost always predicted a recession. This is one of those things where it's hard to deny this statistic, but really the yield curve just comes down to 10-year yields usually are lower because markets tend to price in lower yields over the next 10-year period. But if the Fed's aggressively raising rates in the near term, those near-term bond yields are going to go higher than long-term bond yields. So it's really just a projection of the Fed's policy more than it is an actual recession indicator. Usually when the Fed raises rates this aggressively, you do see a recession. That's why historically the yield curve has predicted recessions. It's as simple as that. Don't look into it too far. It doesn't have to mean we're heading into recession for next year. Good news is household cash and equivalents are at unprecedented levels. As you can see, about $1.8 trillion of household liquid assets that could be converted, put into investments like your good old stock market. It seems like, from my perspective, you don't want to be in these big tech names. The growth, the valuations, way overextended. Your small and mid-cap stocks, I mean, can really be the ones to provide you that alpha, that big growth the next year. Obviously, I'm not a financial advisor. I am not a financial planner. So let me know what you guys think down below in the comments section. That is going to do it for this video. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.